Hey everyone, welcome back to Corporate Decoder, the place where we unravel the secrets hidden in financial filings, and oh boy do we have a gem for you today. We are diving deep into Blackstone Real Estate Investments Trust's latest quarterly report, and let me tell you, it is packed with numbers that tell quite a story. Before we jump into the maze of financial statements, make sure you are subscribed to Corporate Decoder for more dives like this. And if you want to connect with fellow finance enthusiasts, join our Discord community. The link is in the description below. Alright, let us start by looking at their financial health, and for that we turn to their balance sheet. This is like a snapshot of everything the company owns and owes right now. As of the 30th of September 2025, their total assets were a staggering $104 billion. This is a huge amount representing all their properties, investments, and cash. But hold on a second, just a year before that, in December 2024, their total assets were even higher at nearly $116 billion, so we are seeing a pretty significant drop in their overall asset value in just about 9 months. That is something to keep an eye on. Now, liabilities are what the company owes to others, and here we see total liabilities at over $76 billion. This is also down from over $81 billion at the end of 2024, which is a good sign that they are reducing their debt load. And that brings us to equity, which is basically what is left for the owners after all debts are paid. Their total stockholders' equity saw a big drop from around $27 billion in 2024 down to about $20 billion in September 2025. This big chunk of equity disappearing is a direct result of the asset value decrease we saw earlier. It looks like they are divesting some of their holdings, or perhaps revaluing them downwards. Moving on to the income statement, this tells us how much money they made and spent over a period. For the 9 months ending in September 2025, total revenues stood at just under $6 billion. That is down from about $6.4 billion in the same period in 2024. So revenue is shrinking, which naturally impacts profitability. The biggest chunk of their income comes from rental revenue, and that also took a hit, going from over $5.7 billion in 2024 down to about $5.3 billion in 2025. That is a drop of over $400 million in just 9 months. This is a significant decrease, indicating that their rental properties are not bringing in as much money as before. Now, expenses tell an interesting story. Depreciation and amortization, which is basically accounting for the wear and tear on their properties, cost them about $2.4 billion in 2025, down from nearly $2.7 billion in 2024. This decrease makes sense given the overall reduction in their asset value, and likely some property sales, a good sign that costs associated with their existing portfolio are also coming down. But even with some expense reductions, the numbers are not pretty. For the 9 months ending September 2025, their net loss ballooned to over $3.1 billion. That is a huge jump from a loss of about $1.3 billion in the previous year. This dramatic increase in losses is concerning and points to significant challenges in their operations and investment strategy. When we look at the loss specifically attributable to Bright stockholders, the picture is similarly grim. It jumped from about $1.2 billion in losses in 2024 to over $2.8 billion in losses in 2025. This means the shareholders are bearing a heavier burden of the company's financial struggles. Now let us look at the statement of changes in equity. This will show us how their ownership structure and value has shifted. This section is particularly telling. Their accumulated deficit and cumulative distributions, which is essentially their lifetime of losses and distributions paid out, swung from a deficit of just over $15 billion at the end of 2024 to a much larger deficit of over $20 billion by September 2025. This massive increase in deficit highlights the growing losses the company has incurred, which is impacting the equity value per S-share. And the result of this growing deficit is visible in their total stockholders' equity, which dropped significantly from about $27 billion in 2024 to just over $20 billion in September 2025. This is a substantial decrease, showing a real erosion of the shareholders' stake in the company. The statement of cash flows is critical. It shows the actual money moving in and out of the company. Starting with operating activities, their net loss for the 9 months ended September 2025 was over $3.1 billion. Remember, this is the gassed up net loss, so it includes non-cash items. But when we look at the actual cash provided by operating activities, it was about $1.7 billion for 2025, down slightly from $1.6 billion in 2024. This means that despite the large reported net loss, they are still generating some positive cash flow from their core operations. However, the gap between their accounting loss and their cash flow is quite substantial. Financing activities paint a stark picture. Cash used in financing activities was over $10 billion in 2025, a big increase from about $9.1 billion in 2024. This increased outflow is largely due to a significant net decrease in borrowings and especially large repayments of senior obligations from those securitization vehicles. They also repurchased a massive $4.9 billion worth of shares and units, showing a commitment to buy back stock. Let's drill down into some of their core assets. Looking at investments in real estate net, we see a decrease on their balance sheet from over $81 billion at the end of 2024 to about $75.9 billion by September 2025. This confirms the divestment of real estate properties we saw hinted at in revenue and equity changes. Their investments in real estate debt also saw a dip from over $5.2 billion to about $4.6 billion. This suggests they are either selling off some of these investments or not making as many new ones. This is from the fair value measurement section. It highlights a significant portion of their assets and liabilities are valued using level 3 inputs. This means that their valuations rely heavily on unobservable data and management's best judgment, which can introduce a lot of uncertainty and potential for error. For example, when they value their level 3 assets, the unobservable inputs like market yield and weighted average cost of capital are crucial. A small change in these inputs, like a 0.25% shift, can lead to noticeable changes in investment values. For instance, a 0.1% change in discount rate for rental housing could swing their investment values by almost 2%. That is a big deal when you are dealing with billions of dollars. Looking at their investments in real estate debt, we see a significant portion of their portfolio is rated BB or lower, and a substantial 41% is actually not rated at all. This indicates a higher level of risk in these investments, as they are either considered riskier by rating agencies or have not undergone formal rating. What does all this mean for the company's strategy and future? Well, their net loss attributable to Bright stockholders is significantly up year over year. This points to operational challenges that need to be addressed. However, when we strip out some of the non-operational items and look at same property NOI attributable to Bright stockholders, you see a very slight increase. This suggests that the properties they continue to own are performing relatively steadily. The challenge is that they have been selling properties, which accounts for the overall revenue drop, but the core operations of the continuing properties are showing some resilience. Let us look at funds available for distribution, or FAD. This is a measure of how much cash they actually have available after considering many expenses, including those recurring capital expenditures. For the 9 months of 2025, FAD was about $820 million, down from over $954 million in 2024, so even their distributable cash has decreased. This is important because it limits their ability to pay out distributions to shareholders. Now, looking at the big picture with Blackstone's Real Estate Income Trust, or BRIGHT, we see a company that has been actively selling off assets. This is evident in the declining revenues and the shrinking equity balance. The strategy seems to be a pruning process, likely to shed underperforming or non-core assets and focus on more stable or high-growth areas. The jump in impairment charges also suggests they are taking proactive steps to write down the value of assets that are no longer worth what they thought, which is a responsible, if painful, accounting move. The increased net loss is largely driven by factors outside of their core property operations, such as losses from unconsolidated entities and the impact of interest rate derivatives. This suggests that while their real estate portfolio might be finding its footing, external market forces and complex financial instruments are weighing heavily on their bottom line. The significant share repurchases indicate a belief from management that their stock is undervalued, or that they are trying to support the share price in the face of these losses. However, the massive increase in their accumulated deficit is a warning sign that without a significant turnaround in their core operations and a favorable economic environment, the path ahead could be challenging. My take on Bright right now is they are in a transitional phase. They are actively shedding assets and managing their debt, which is positive. However, the substantial increase in net loss and the shrinking equity raise serious concerns about profitability and the overall health of their investment strategy. The reliance on complex financial instruments and the performance participation allocation also add layers of complexity and cost. They need to demonstrate a clear path to profitability and sustainable growth in their core real estate operations to regain investor confidence. What do you think about Bright's latest report? Are they making the right moves for the future? Let me know your thoughts in the comments below, and if you found this deep dive valuable, please hit that like button and subscribe for more. And remember to join our Discord community for even more discussions and insights. Thanks for watching, and I will see you in the next Corporate Decoder.